Not everyone is confident about the Treasury's latest plan to rid bank balance sheets of toxic assets. Princeton University's Nobel Prize-winning economist Paul Krugman says it won't work. Our Kathleen Hayes is in Washington for our exclusive interview with Mr. Krugman. Kathleen?
Paul, Mark, so much. And Paul, to you, yesterday here on Bloomberg Television, we asked Larry Summers, economic advisor to the president, also a prominent economist, not a Nobel winner, but a prominent one nevertheless, about your objection to the plan. And Larry said basically he thinks he couldn't understand why you object. Maybe you don't understand it. I've assumed you've read it thoroughly. Can you explain to Larry and the rest of us why you think this plan won't work?
Yeah, I mean, this plan is, once you strip away the basically confusing details, it is the same plan that Hank Paulson, the Treasury Secretary, proposed back in September. It is right back to we're going to have the government buy up some of these toxic assets in the hope of driving up their price enough to make the banks whole again. It's disguised, it's done through these loans, but it's a very sweet deal. Basically, investors who participate in the plan are given a shiny new toaster plus a gigantic put option as part of the deal, which makes it a very attractive thing, so they're going to buy the stuff. The problem with the plan is that first of all, it is a pretty bad deal for the taxpayers. It's not well focused on the problem of the most troubled banks, and it's very unlikely to produce enough gain in the prices of these assets to make the banks viable again, the most troubled banks viable. It's a very diffuse, ill-defined instrument. Now, I think Larry understands what I'm saying perfectly well, but he has to say what he has to say.
Well, Sheila Bair, who's head of the FDIC, I'm actually going to be interviewing her later this afternoon, has said a couple of times recently that she knows what the banks are holding on their books, and she thinks they are definitely being undervalued by the market. She sees value in those assets, Paul. Isn't it possible that this program will tease some of that value out?
Well, there's a reasonable case that's somewhat undervalued, right? So you have banks that are holding stuff on their books at 60% of face value, and the market price, if they were to try to sell it, is 30 cents. And maybe it's really worth 40 cents. That's a possibility. But would pushing that price from 30 to 40 be enough, first of all, even to make the banks willing to sell it? Because they don't want to mark down the stuff they're holding on their books. They're really afraid of what that would do to their measured capital. Basically, they can't handle the truth. Do we really think that's going to be enough to make the banks whole, even if they do sell it? It's a real, you have to believe, it's not enough to say that the stuff may be somewhat undervalued. There's a good case that it is, though that's not for sure. But it has to be grossly undervalued for this plan to be capable of actually doing more than just handing some extra money to people who are holding toxic waste.
But of course, value isn't something that's static. Prices change all the time, and value can change over time, too, as the economy changes. And right now, we're in the deepest part of the recession. There's even some signs people would say maybe the recession is bottoming out. As the underlying economy changes, Paul, isn't it possible that some of these assets do have their value increase? And isn't that also what this plan is trying to foment, kind of an upward spiral rather than a downward spiral?
Well, yeah, but you have to believe that there's really the possibility of a self-fulfilling prophecy here, that if only people feel better about this stuff, the economy will surge so much, and the bank's the value of these assets will surge so much that it will make everything fine. And to believe that, you really have to believe that most of the problems facing the banking system are the result of a more or less irrational panic, that there isn't a fundamental huge loss facing the system. I don't think that's right. I mean, essentially our banking system, certainly some of the biggest banks, bet heavily on the idea that home prices at 2006 levels made sense, on the idea that consumer debt at unprecedented levels relative to consumer incomes made sense. Those bets were wrong. There's a tremendous loss that you can't wish away, that even if you had full return of normality in the markets would still be there. And if you can't make it go away, then the idea that we're going to get this self-fulfilling thing where the economy improves, confidence improves, everything fixes itself is just not going to happen. Because the other policies are not in place. We have a stimulus plan that is helpful but not nearly big enough to produce recovery. there is nothing out there suggesting that we're going to have an economic recovery anytime soon. We might see the pace of decline level off. But the idea that we're going to bounce back to full employment anytime in years is hard to credit at this point. So I think you really don't want the centerpiece of your financial strategy based upon hope that something that probably isn't true might be true.
Okay, Paul. Well, got a lot more questions I want to ask you. Certainly, Paul Krugman caught a lot of attention with his two recent columns. One where he said that this move to partner, a public-private partnership to buy out the toxic debt, made him feel despair more than disappointment. I want to ask Paul about that. And also him saying that he still seems to favor nationalizing the banks, something the administration, the Fed, the Treasury Department seem to be firmly against. We're going to continue this conversation with Paul Krugman. Also get his view on Goldman Sachs announcing that it would like to pull out of the TARP, give its money back to the government. What does that mean for the government's plan to get the banking system back on track? Again, a lot more with Nobel Prize-winning economist Paul Krugman next here on Bloomberg Television in my exclusive interview.
Let's go back to Kathleen Hayes. She's in Washington, and then over to Princeton and her guest Paul Krugman, the Nobel Prize-winning economist. Kathleen?
Paul, you seem to think that this new plan, the PPIP, is going to be a failure. If that's the case, do you expect that ultimately the bank regulators are going to have to look at nationalization of some of these big banks? Again, this is something Larry Summers and others have rejected repeatedly. They say it won't work in the United States. It would cause too much havoc. It just is an impossible idea. What is yours?
No, I think in the end we'll come to it. Nationalization, or actually receivership, is just a piece of this. It's always a two-part thing. On the one hand, you create confidence in the banking system by guaranteeing the liabilities. And on the other hand, then paired with that, you have to take the weakest banks, the ones that are actually insolvent, and temporarily take them over. So it's not nationalization just by itself. You don't just seize bank number 1 and bank number 2, and then everybody runs out of bank number 3 and 4 because, who knows, they're no longer safe. Instead, you guarantee liabilities of everybody, but seize the big ones. And that's the way it has always worked in financial crises. It's what we did ourselves with the savings and loans after the 1980s debacle. So that's what's going to happen, I think. It's just, this is putting off that day.
Paul, Goldman Sachs is looking at returning its TARP funds. What will that do to the TARP plan? And does that really sink the government's efforts?
Well, I think that pushes us further in the direction of what I just described, the sort of guarantee plus nationalization, because all of the plans they've tried so far, they're trying to avoid stigmatizing anybody. This is the whole thing. They don't want to say, well, this bank is bad and that one. So they tried to get everybody to take TARP money, even some of the firms that didn't need it. And then it turns out, of course, there are popular demand that there be some restrictions on companies that do stuff with government money. And the firms that don't really need the money don't want to live under those restrictions. So what we're actually seeing is the Goldman thing is actually a breakdown of the strategy that is reflected in the Geithner plan. It's basically saying you cannot do this with a plan that does not, in fact, try to distinguish between banks that are in trouble and banks that are not.
So we just got the announcement that the Fed is going to start buying Treasury bonds. Now, they'd already announced they were going to do it, but now we know they are actually starting. What is the impact of this going to be? Is this going to help get the economy back on track, get the banking system back on track?
Oh, yeah. I mean, it certainly helped the economy get back on track. I don't know about the banking system, but no, this is good. I mean, this is what we need. This is quantitative easing, as everybody calls it now. And, the Fed, with short-term rates under 1/10 of 1 percentage point, the Fed doesn't have any leverage through traditional monetary policy. But it can get traction through other stuff. And this is one of the things it can do. There are some risks. There is a chance that the Fed will end up losing money by buying when interest rates are low and having to sell when they're high. But it's worth doing. I'm all in favor. I think that using the expanded, enhanced printing press is one of the things we really can do to get out of this crisis.
Paul, I talked to a money manager yesterday who said this changes everything. How he interprets this is the Fed has announced, yes, we're just going to run the printing press flat out, we're going to devalue the dollar, and we're going to inflate our way out of our troubles. How do you answer that?
Well, I mean, inflating our way out of our troubles is, if we can do it, is a good thing. I mean, if you could guarantee me 4% inflation for the next 5 years, if the Fed could guarantee me that, that would probably solve our problems. Now, the question is, do you think it's going to explode into an uncontrolled inflation later on? And I think the answer is no. I mean, the Fed is not printing money to cover the government's bills. It's printing money to try and rescue the economy from deflation. And they're itching. The moment they can, they're going to try and shrink that balance sheet back down. So this is not out of control monetary policy. This is monetary policy looking for, desperately seeking traction at a time when the rest of us need them to find some traction.
Speaking of traction, stock market's up 20% from the lows now. We've seen some signs the consumer is still spending some money. There's a couple of positive signs in the housing market. Do you have any sense, again, Paul, that maybe you're a little bit overly pessimistic on the economy? It might do a little bit better this year than you're projecting?
Well, I hope so. I mean, I would not be surprised to see GDP stabilize late in the year. I wouldn't be surprised if the economy's free fall comes to an end, but it's very hard to see growth taking place at rates that are enough to even take up the growth in the labor force. Basically, we're looking almost certainly at what people used to call a growth recession at best, a situation in which GDP rises but unemployment rises.
Okay. Paul Krugman, thanks for joining us. Appreciate you taking the time.
Thank you.